The stock market can feel like a wild roller coaster. One minute you're up, the next you're wondering where half your money went. Millions of everyday investors struggle to make a profit, especially with how volatile the market's been recently. You probably heard that one of the safest and most effective ways to invest is by putting a fixed amount into a broad market index fund every month, a strategy called dollar cost averaging, or DCA for short. And then there's another famous line, buy the dip. When prices fall, you swoop in and grab a deal. But here's the truth, most people fail to buy the dip. They either jump into a fad too early or they freeze up when their portfolio drops 30, 40, even 50%. So is there a way to keep things as simple and consistent as dollar cost averaging while still taking advantage of market dips? In this video, I'm going to walk you through why DCA works, where it struggles, especially in a bear market, and how to level it up with just a little extra effort, so that you can stay calm, invest smarter, and make the most of today's market opportunities. Alright, let's start with the basics. If you are new to investing or just want something simple that actually works, there's one strategy I can't recommend enough: dollar cost averaging into a broad market index fund or ETF. Here's what it means. You pick something like the S&P 500 ETF VOO, for example, and you invest a fixed amount of money into it on a regular basis. That could be $5 a week, $200 a month, whatever fits your budget. The key is consistency. Some weeks you will buy when the market's high, some when it's low, but over time it averages out. That's where the name dollar cost averaging or DCA comes from. Now, why is this such a great strategy, especially for everyday investors? First, you don't need a huge amount of money to get started. Whether it's $5 or $5 grand, you can begin right now, no barriers. Second, you don't have to save up a big lump sum every time. Just take a small portion of your paycheck and invest it automatically. Set it, forget it, and let it grow. Third, and maybe most important, you don't need to be a stock picking genius. When you invest in a broad market index fund, you are buying a slice of hundreds of top companies all at once. If you believe the US economy will grow over time, that investment grows with it. It's simple, it's low stress, and over the long run, it works. John Bogle, one of the most respected names in the investing world, said this is the best strategy for the average investor, and honestly, he's right. I've been testing this out myself, right here on this channel. I've been putting $50 a week into VOO for 2 years and 10 months now. As of today, I've invested a total of $7,400, and my portfolio has grown by 13.7% even after devastating pullback recently. If you want to see how it's going, feel free to check out that series on my channel. You know, even the 401k system most people use for retirement is based on this exact strategy. Putting aside a portion of each paycheck, investing it into index funds and bonds, and letting time do the heavy lifting. Millions of people have used this method to build real wealth without needing a finance degree. So if you want to invest without the stress, DCA into a broad market index fund is one of the smartest ways to do it. Simple, steady, and surprisingly powerful. Now let's talk about the flip side. Dollar cost averaging is a solid long-term strategy, but like anything, it's not perfect. One of its biggest drawbacks, it can miss some of the best opportunities, especially when the market drops fast. Let me explain. If you are investing every 2 weeks, that's 26 times a year. If you are doing it monthly, it's just 12. That means you are only jumping into the market a handful of days each year and sitting out the rest. So when the market dips or rebounds hard, it's a toss-up whether your scheduled buy will land on one of those golden days. Take a recent example. The S&P 500 dropped nearly 20% in just 1 month and a half. If your auto invest happened to fall during this slide, great. You picked up some shares at a discount. But on April 9th, the market suddenly bounced 10% in just a day. And if your next buy was a week later, you missed it. That one day could have been your entire year's return, since the S&P 500 averages about 10% return annually. So that's the downside. DCA smooths out your cost, but it also disconnects you from the rhythm of the market. Whether price spikes or crash, you just keep buying on schedule, no reaction, no adjustment. Don't get me wrong, that's not a bad thing. In fact, for most people, it's exactly what they need. Because let's be honest, when the market starts free falling, emotions take over. And making emotional investing decisions, it's a fast way to burn through your money. Just browse Reddit for 5 minutes and you'll find story after story of people panic buying, panic selling, and regretting every bit of it. So if you're using DCA and occasionally miss a big green day, that's totally okay. You're still in the game and your portfolio is still growing. But what if you do want to catch just 1 or 2 of those golden opportunities? What if there's a way to be a little more greedy without taking a ton of actual risk? Well, there it is. So how can an everyday investor actually take advantage of big market dips without falling into risky territory? Here's a simple plan. First, aside from your regular investment into the S&P 500 index fund, you need to set aside an actual chunk of cash, what I like to call your opportunity fund. If saving up actual cash has been really tough for you, I made a full video on how to build and manage cash reserves in your portfolio. Go check that out if you haven't already. Now here's how this strategy works. Every time the market drops 10% from its recent peak, you invest 1/10 of that opportunity fund. Let's walk through an example. Back in March 2020, during the COVID crash, the S&P 500 ETF VOO dropped about 35% from its peak. If you had $5,000 set aside and followed this plan, you would invest it 3 times, $500 each time as the market dropped past the 10%, 20%, and 30% marks. You would pick up 6 shares in total at an average price of $246.50 each. Fast forward to today, those shares are now worth about $3,000 in total. You double your original investment. So what's the difference between this and the regular dollar cost averaging? With DCA, you are buying based on the calendar, like every 2 weeks or every month. It doesn't care what the market's doing. But with this strategy, you are buying based on the price action. You're waiting for the market to dip and then stepping in calmly and methodically. Now some of you might be wondering, can I go a bit more aggressive? Like invest 1/5 of my fund every time the market drops 5%? Technically, yes, but here's the risk. If you go too hard too fast, you might run out of money before the market bottoms out. Let's say you invest 1/5 every time the market falls 5% from the peak. That's 5 rounds, and you are out of cash after a 25% drop. But what if the market keeps falling? It happened before. During the Great Depression, the S&P 500 fell by over 80%. During the 2008 financial crisis, it dropped nearly 60%. If you already spent your entire opportunity fund by the time the market is really crashing, not only do you miss those deeper discounts, you're also risking panicking and selling at the worst possible time. That's why I recommend keeping it conservative. My 10-10 plan might seem cautious, but even if the market dropped 99%, I still have cash left to buy. Can your plan say the same? Alright, before you start testing out this strategy with your own portfolio, here's a few things to keep in mind. First, this is just a bonus strategy. Think of it as a little upgrade to a regular dollar cost averaging plan, not a replacement. DCA into a broad market index fund is still the best strategy for most people. If you don't have any actual cash set aside, no problem, just keep following your DCA routine. That alone can still build you a solid fortune over time. Second, use this strategy only with a broad market index fund like the S&P 500. The whole point here is that the market as a whole tends to bounce back eventually. That's not guaranteed for individual stocks. If one company crashes 80%, there's no promise it'll ever recover. So stick to the entire market, not just one stock. Third, make your life easier, automate it. Once you figure out your entry points, go into your investment account and set limit buy orders at these prices. Just make sure to change the expiration setting to good till cancelled or never expire. That way you don't have to stare at charts all day long or worry about missing your moment. You set it and forget it. Next, base each entry on the peak, not your last buy. Every time you invest, it should be triggered by a 10% drop from the most recent market high, not from the price you last bought in at. If you keep calculating from a last purchase, you'll burn through your cash way too fast. Lastly, keep your expectations realistic. You don't control how far the market will fall or how much of your opportunity fund you'll eventually end up using. Maybe it drops 31%, maybe 76%, or maybe just 12%. The point isn't to time it perfectly. Most people regret not buying more, but that's just great talking. Instead, treat these actual shares as bonus shares. Be glad you got them, don't stress about how many. The bonus is a win, so enjoy the win. Now you got the full picture, an easy low-risk strategy that works alongside your regular investing routine and gives you a practical way to take advantage of market dips. Just remember, stay consistent, be patient, keep some cash on side, and be ready when opportunity knocks. That's how everyday investors like us win in the long run. If you found this video helpful, hit that like button and subscribe for more content like this. Thanks for watching, and as always, hope you have a profitable day. I'll catch you in the next one.